Marcus Padley joining us, Marcus, today. Marcus, welcome to Wednesday. Records aplenty at the moment. Anywhere you look, essentially. Can this momentum continue, do you think?
Look, everybody is asking the question, aren't they? How long can this continue? I saw a good line from one morning writer this morning, which said there's been a ramp up in articles highlighting bubble, circularity, which is all the big tech companies doing deals with each other, which is sort of a bit incestuous, doesn't necessarily lead to earnings. Return on investment, which is the big issue. It's all right investing. The capex continues. Nvidia makes money. Chip companies make money. But what about the rest? And productivity concerns. Everybody's trying to guess it. I liked a line from Morgan Stanley yesterday, which said all the dreams being priced into markets may not come true. And I wouldn't liken this to a tech boom, but I did live through the tech boom. And the thing that happened in the tech boom is all the ideas were fantastic. Imagine back in 2000 that someone suggests to you that for the first time in your life, you'll be able to shop online and they'll deliver it. What a fantastic idea. And of course, it came true. But the share prices went 2 decades ahead of themselves, pricing in the earnings. And I think what we've got here is, again, I think what will puncture this, if anything will be a dose of reality. The whole herd's doing 200 miles an hour with its hair on fire. Everyone's a hero. Everyone's a genius. Whether it's whatever theme is running, it's running on sentiment, be that gold, Asia tech, defense, copper, resources, small resources. One sentiment, one bit of damage to sentiment could pop all the bubbles. So I think we're at elevated, slightly dangerous levels, and any trader who was taking a profit now could not be blamed. The NASDAQ, for the first time since June 2024, is overbought. You'll go bust being short term, bust in the long term, trading charts in the short term, but we're overbought on a weekly chart for the first time since middle of last year. And in the middle of last year, the NASDAQ, for almost no reason other than this change in herd sentiment, dropped 15% in 5 weeks. I think we're vulnerable to that. But the problem is, what's going to cause it?
Yeah, well, I mean, that's the question, isn't it? So, Marcus, you just said there you couldn't be blamed if you're taking profits in this current environment. Is that what you're doing at the moment?
Andrew, we had a big debate this morning about we've got these principles that we work by. One of them is react, don't predict. No one's smart enough to make predictions, but one of our other principles is no principle is set in stone. So we can predict if we want to, and we have thought very hard about preemptively selling in order to lock in what has been a fabulous run for our strategy fund. We're up 20%. We're up over 20% in 8 months. As I say, lots of people are doing that, but we don't want to lose it, and we're debating whether to sell just because we know from experience that we're in this sentiment. A bubble's too strong a word. It's not really a bubble yet, but we're in a sentiment balloon, and it's pretty vulnerable. We've decided for the moment to go with, is it Chuck Prince's line from Citibank? Whilst the music's playing, you have to dance. We're still dancing, but we're fearful the lights will suddenly come on.
All right, and that chair may be ripped from beneath you. Are you still fully invested, though, stateside? Is that where you're at the moment?
Yes, fully invested, and with a bias to, we got half the money in the NASDAQ and the S&P 500, the other half in SEMI and FANG. And I can see, if you look at some of the share price movements today in stocks that haven't got a headline, it's very headline driven at the moment, but you've got things like ASML down 3.9%, Applied Materials down 5.5%, Oracle down 2.5%, CrowdStrike down 2.3%, Snowflake 3.2%, KLA down 4.8%. You know, this is not down 0.1, down 0.3. The tide is sucking on anything that hasn't got a headline at the moment, and I can't help thinking that we're somewhere near a top now.
It's interesting too, of course, we're in the midst of that US government shutdown. Previously, we have seen markets shrug that off. Is that what they're doing at the moment? Because, I mean, you only have to take a look at gold on the prospect of perhaps this shutdown being extended, plus, of course, those rate cuts to come.
Well, I think, Andrew, the issue with gold is that this shutdown has to be sorted, almost always is sorted. And when it is sorted, all that gold, the gold sentiment will change for the worse. There are lots of the big thing driving gold is central bank buying. So that this theme may just carry on. But in the short term, I wouldn't say the government shutdown's a reason to be buying gold. It's a reason because this could end instantaneously, and then gold could sort of tip over. So I wouldn't be. This is short-term stuff, that shutdown. It will be sorted. But what it does do, of course, is create a narrative around US debt, US overspending, political impasse, and none of that is a positive. So I don't think it's going to be an issue. But as I say, from such a sentiment-driven market rally, it's not going to take much to cause leakage from prices, and that could be it if it gets extended. I think the bookies betting on 11 days. We're in day 7. The extremes 29 days. If we start getting to the end of this month without a shutdown solution, I'd be very surprised, but it would start to get worrying maybe.
All right. Yeah. Now, any bright spots here locally? Any reason to be invested in Australia?
Well, look, I'll tell you this. Henry, who you have on a bit, Henry runs a small cap portfolio, and it's a difficult portfolio to run at any time. He currently has 29 stocks in that small cap portfolio. It's biased to resources, and the average gain on 29 stocks is over 40%, right? So resources have been flying, and a lot of those resource stocks are again sentiment driven in the lithium, uranium. It's not an earnings story, it's a sentiment story. And that has been a very bright spot, but I think it's vulnerable. Outside of that, we're watching our growth stocks. We've got a growth portfolio. It is struggling at the moment as big tech sentiment sort of gets up there. I can feel it's going to get pummeled the moment sentiment changes, because a lot of those are high PE, low yield, no yield stocks that need sentiment. So all these, there are so many good spots in the market at the moment. Banks are just boring sideways, got the results season coming up. But there are so many good spots. I think we need to not think about what's great. We need to think about what is going to get hurt when this thing turns around.
Well,
and it's pretty obvious it's going to be resources, small resources.